Hello and welcome. Today let's dive into taxation. Definition of direct taxes, imposed on an individual or entity, and its burden cannot be shifted to others. Examples include income tax, wealth tax, property tax, estate duties, capital gains tax, and corporate tax. Common direct taxes, income tax, paid by individuals, HUFs, cooperatives, and trusts. Corporate tax, imposed on companies for income earned in India and overseas. Property tax, obligatory payment by property owners, varying by state rules. Gift tax, applied if a gift exceeds Rs.
Rupees 50,000 annually.
Advantages, merits of direct taxes. See Read E. 1. Certainty. Taxpayers know the exact amount to pay in advance, aiding accurate revenue estimation. 2. Relatively elastic. Direct taxes yield more with rising income and wealth, allowing the government to adjust revenue by changing tax rates. 3. Equity. Based on the ability to pay, ensuring social justice. 4. Anti-inflationary. Can help control inflation by adjusting tax rates during inflationary periods. 5. Direct awareness. Taxpayers directly feel the burden, fostering awareness of public fund usage. 6. Economical. Cost-effective collection methods, such as deducting personal income tax at the source. Disadvantages, demerits of direct taxes. TAINES. 1. Tax evasion. High tax rates, documentation, and poor tax administration lead to extensive tax evasion, especially in less developed countries. 2. Arbitrary rates. Determining rates lacks an objective basis, and exemption limits are often arbitrary. Achieving precise progression is difficult. 3. Inconvenient. Involves complex procedures and formalities, making it inconvenient and psychologically painful for taxpayers. 4. Narrow coverage. Only about 3% of the population pays personal income tax, resulting in insufficient funds for public expenditure. 5. Effects on capital formation. Can reduce net income, leading to lower savings and investment, negatively impacting capital formation. 6. Sectoral imbalance. Imbalance in taxing sectors, with heavy taxes on corporate sectors and 100% tax exemption for agriculture. Conclusion on direct taxes. Despite challenges, direct taxation remains crucial in modern financial systems. The extent of direct taxation should align with the economic state of the country. Direct taxes have the disadvantage of being non-shifted, mainly due to administrative difficulties. Richer countries generally have more scope for direct taxation.
Hello and welcome. Today, we're diving into an exciting and crucial aspect of economics, sources of public revenue. Indirect taxes. Meaning, definition of indirect taxes, levied by the government and collected by intermediaries, shifting the economic burden to the ultimate consumer. Imposed on the purchase of goods or services, and the burden can be passed on to the end consumer. Examples include commodity taxes, sales tax, excise duty, custom duties, etc. Forms of indirect taxes. Customs duty. Levied on imported and exported items. Excise duty. tax payable on goods manufactured in India for domestic consumption. Service tax. Applied on services such as food and beverage, travel, and recreation. Value-added tax, VAT, applied at each stage of product sale, with the final consumer bearing the tax. Securities transaction tax, levied on all transactions on a stock exchange. Reasons for being indirect. Indirect taxes allow the initial taxpayer to shift the burden to someone else. They are first charged at the manufacturer's level but eventually get transferred to the end consumer. Administrative classification. Hicks classifies direct and indirect taxes based on administrative arrangements. Direct taxes involve a direct relationship between taxpayers and revenue authorities, while indirect taxes are collected through traders and manufacturers. Advantages, merits of indirect taxes. CDWEU. 1. Convenient. Indirect taxes are less burdensome as the burden may be shifted to consumers who pay it as part of the purchase price. This makes it a more convenient form of taxation. 2. Difficult to evade. Safeguards are in place, making evasion challenging. Sellers are obligated to collect and remit taxes to the government, reducing the likelihood of tax evasion. 3. Wide coverage. Indirect taxes apply to a broad range of products and services, ensuring widespread contribution. This wide coverage contributes to a more inclusive taxation system. 4. Elasticity. Some indirect taxes exhibit elasticity, allowing the government to increase revenues during prosperous times. This flexibility is advantageous for adapting to changing economic conditions. 5. Universality. Indirect taxes are paid by all classes of people, making them broad-based. Even though they may be progressive in nature, they are universally applicable, ensuring a more comprehensive tax base. Disadvantages, demerits of indirect taxes. Ha-il up. 1. High cost of collection. Indirect taxes require elaborate administrative machinery, leading to higher collection costs. This can be inefficient in terms of resource allocation. 2. Increase income inequalities. The regressive nature of indirect taxes may contribute to income disparities among the rich and poor. It places a relatively higher burden on lower income groups. 3. Affects consumption. High duties on certain products may reduce consumption. This can have a negative impact on economic growth as reduced consumption affects production activities. 4. Lack of social consciousness. Taxpayers don't feel the burden directly, leading to a lack of awareness about taxes paid. This may result in reduced engagement and understanding of the tax system. 5. Uncertainty. Indirect taxes, especially on commodities with elastic demand, can be uncertain. Changes in quantity demanded may affect revenue collection, introducing uncertainty into tax planning. 6. Inflationary. Indirect taxes increase the prices of goods and services. This contributes to inflation, impacting the overall cost of living. 7. Possibility of tax evasion. There is a possibility of tax evasion, as customers may evade taxes by purchasing items without proper documentation. This undermines the effectiveness of the tax system. Remembering these disadvantages can be simplified with the acronym Ha-il up. Conclusion on indirect taxes. Direct and indirect taxes are complementary in a rational tax structure. Direct taxes tend to be progressive, indirect taxes regressive. Both play essential roles in revenue generation, with direct taxes having a limited scope. A balance between both types is crucial for a well-rounded tax system.